Hello and welcome to the LP Financial Services Forex Trading Class, Introduction to Trading Strategy videos. In Lesson 1, Money Management, Part 1, Leverage and Risk Leverage, we see that the second type of leverage that it's important to understand is called risk leverage. The risk leverage is calculated based on trading a lot size equal to the total funds in your trading account for each trade. This equates to how many lots you control based on your account equity. If you trade one $10,000 mini lot per trade for every $10,000 in total account equity, you'll have a risk leverage of 1 to 1. You're controlling an equal amount of currency as you have in account equity. If you're controlling 10 $10,000 mini lots, you're controlling $100,000 in currency. And have $10,000 total account equity, you'll have a risk leverage factor of 10 to 1. The lower your risk leverage is, the less of your trading account is at risk on any one trade. For example, the client places $100 of account balance of a $10,000 trading account to buy one $10,000 euro mini lot. The leverage of 100 to 1 is given to the client from the currency dealer to allow the client to buy the $10,000 euro mini lot. The risk leverage equates to one $10,000 mini lot against $10,000 in account equity for a risk leverage factor of 1 to 1. When we look at the risk leverage model, which is based on trading a lot size twice the total funds in your trading account for each trade, which gives you a 2 to 1 risk leverage factor. For example, this equates to trading two $10,000 mini lots per trade for every $10,000 in total account equity, or trading two $100,000 lots for every $100,000 in total account equity. The chart below will better illustrate this with the euro calculated using a constant pip value of $10 per standard 100K lot or $1 per mini 10K lot. If investor A and investor B buy the euro at 1.35 and employ a 2 to 1 risk leverage model, we can see that investor A would buy two mini $10,000 contracts. He would then control $20,000 worth of currency in a $10,000 account, giving him a 2 to 1 risk leverage factor. Now, if the euro rises 100 pips, he would gain 200 pips as he has two contracts at $1 per pip and would profit $200. If the euro falls 100 pips versus US dollar, he would lose 200 pips as he has two contracts at $1 a pip or lose $200. This would equate to risking 2% of your total account equity on any one trade, as $200 is 2% of $10,000. Investor B, in a $100,000 account using the same risk leverage model, would buy two standard $100,000 lots. If the euro rose versus the US dollar by 100 pips, he would gain 200 pips, this time at $10 per pip, for a profit of $2,000. If the euro falls versus the US dollar 100 pips, he would lose 200 pips as he had two contracts at $10 a pip, or lose $2,000. So he will gain or lose the same amount of money with 100 pips profit or loss. The difference is that he is risking 10 times the amount. He's not taking 10 times the risk. He's taking 10 times the amount, as these employ the same risk leverage model. As you can see, $2,000 is equally only 2% of the trading account at risk, using a 2 to 1 risk leverage model. Determining the risk leverage you use is the most important factor in managing your risk. Trading your signals at a 2 to 1 risk leverage model, you will try not to risk more than 2% per trade. You can reduce your risk leverage to 1% of total equity by reducing the distance of your stop loss to 50 points in this example, or by only trading one lot of currency as opposed to two lots of the mini or standard size. In our next video, we'll learn about Lesson 2, Trading Psychology. In our next video, Lesson 1, Money Management, we'll talk about Part 2, Trading Plans and Stop Loss.